federal employees. Did you know the life insurance benefit you've been counting on to protect your family might come with a surprise guest at tax time? And that guest's name is the IRS? We're talking about FEGLI, the Federal Employees Group Life Insurance Program, and the tax traps hiding inside a benefit most people assume is completely clean. Here's the thing, life insurance death benefits are, in the vast majority of cases, completely income tax-free when paid out as a lump sum, which sounds like the end of the story, but it is very much not the end of the story. The moment you add layers, employer contributions, ownership structures, or interest, the IRS pulls up a chair and starts doing math. Let's start with imputed income, which sounds like something a tax attorney made up to justify their hourly rate, but it is absolutely real and it is sitting on your W-2 right now. If your employer-provided FEGLI coverage exceeds $50,000 in value, the IRS treats that excess as taxable income, meaning you are being taxed on a benefit you haven't even received yet. Think of it like this. The government gives you an umbrella, but then charges you for the raindrops it catches above a certain height, which is absurd, but also completely legal, and that's the world we live in. The good news is that this imputed income is already calculated and reported for you, so you won't be blindsided at filing if you know where to look on your W-2. Now brace yourself, because this next one has an actual name that sounds like a villain from a legal thriller, The Goodman Triangle. This is a scenario where 3 different people hold 3 different roles in a policy. One person owns the policy, a second person is the insured, and a third person is the beneficiary, and that structure can trigger gift taxes on the payout. Imagine your spouse owns a policy on your life, and your adult child is the beneficiary the moment that death benefit lands in your child's hands. The IRS may view it as a taxable gift from your spouse, which is both counterintuitive and financially painful at the worst possible moment. The fix is almost embarrassingly simple. Align the ownership and beneficiary roles thoughtfully, and get a professional to review your policy structure before it becomes someone else's problem. Estate taxes are another layer most federal employees never think about because, frankly, the death benefit feels like it should exist outside the estate, but it doesn't always. If you own your own life insurance policy at the time of your death, that benefit can be pulled into your taxable estate. And if your total estate exceeds federal or state exemption thresholds, your family could owe taxes on money they thought was protected. History has shown us that families lose significant portions of otherwise tax-efficient assets simply because no one thought to transfer ownership of a policy or establish an irrevocable life insurance trust before it was too late. This isn't a new problem. It's a predictable, documented, recurring mistake that estate planners have been warning about for decades, which makes it simultaneously frustrating and entirely avoidable. A common misconception is that if a death benefit is tax-free at the federal level, it must be tax-free everywhere, but state-level estate and inheritance tax rules vary wildly, and some states have exemption thresholds far below the federal limit. You could be completely clear of federal estate tax and still owe your state a meaningful check, which is why knowing your state's specific rules isn't optional, it's essential. On the brighter side, living benefits like chronic illness riders are generally designed to provide tax-free access to funds while you're still alive, which is a genuinely powerful feature if you ever face a qualifying health crisis. The cash value inside a whole life policy also grows on a tax-deferred basis, meaning you won't owe taxes on that growth until you actually withdraw it, so the structure, when used correctly, can be a legitimate tax-efficient vehicle. The practical lesson here is not to panic, but to audit, pull out your FEGLI documentation, look at your coverage levels, check who owns what, and verify your beneficiary designations are structured in a way that doesn't accidentally create a tax event. Disciplined, unemotional review of your policy structure once a year is worth more than any amount of last-minute scrambling when a life event actually occurs. Position sizing matters here too. Don't over-insure to the point where imputed income becomes a meaningful annual tax drag. And don't under-insure in an attempt to stay below thresholds because the protection gap you create could cost your family far more than any tax bill. The goal is a rational, calibrated strategy that serves the original purpose of the coverage financial security without creating unintended fiscal consequences along the way. At the end of the day, life insurance is one of the most emotionally charged financial tools a person can own. And it deserves the same level of clear-eyed, systematic thinking as any other part of your financial plan. Discipline, proper structuring, and consistent review are what separate families who receive the full intended benefit from those who learn the hard way that the details matter enormously. The irony is that a benefit designed entirely to provide security can become a source of financial stress simply because of paperwork, ownership lines, and thresholds that nobody explained clearly, but now you know, and knowing is the leverage point. Whether you're comfortable with where you stand or realizing you've got some restructuring to do, the important thing is that you're making informed, rational decisions rather than hoping for the best. And if you're ready to take the next step, whether that's exploring real estate investing, tackling a home contracting project, or connecting with the right lenders, we can help you get started. So check out our links in the description below.